Welcome back to the Real Estate Roadmap Podcast. I'm your host, Matt Jones, and this is episode 2 of the Foundation series. Before we jump into house hacking, I felt that it was important to discuss financing options, and I originally intended to cover traditional DSCR, commercial, and hard money financing all in one episode, which may have been a little ambitious. But traditional financing is far and away the most common option for buyers when they're house hacking. So I started there, and my guest, Nick Redhead, did such a phenomenal job that I decided to make it a standalone episode. Traditional financing includes loans like conventional, FHA, and VA. They generally are more accessible and offer better pricing and terms than other lending options. Because our interview went a little long and the content he shared was so valuable, I'm going to jump right into my interview with Nick. Enjoy. I'd like to welcome my friend and top local lender, Nick Redhead, with Guaranteed Rate Affinity, to educate us on conventional VA and FHA loans. Welcome, Nick. Please take a moment and tell the audience about yourself and about Guaranteed Rate Affinity, and then we'll dive right in.
How you doing, Matt? Thanks so much for having me today. Really appreciate it.
Absolutely.
So my name is Nick Redhead. I've been in the mortgage and lending space for 19 going on 20 years. Wow. Currently a producing regional manager with Guaranteed Rate Affinity. Historically, I've kind of been through the gamut from a finance company to a little bit of subprime lending to working with a few different banks, small, medium, big, and then have worked with a couple different mortgage companies and just strictly doing mortgages. Guaranteed Rate Affinity is I believe we're third right now, ranked third as far as the third largest lender. And I think Wells Fargo is going to be bailing out of that space here. So I think we're going to be taking second as far as that's concerned. So, yeah.
Okay. Awesome. Can you give us, to get started, a brief overview of the loan types that you offer, kind of how they vary from one type to another, and then how they vary when being used for investment purposes or to purchase multifamily property?
Sure. So across the board, we have an array of product. So, we're set up to where we do a lot of different loans straight through Fannie Freddie. We're a seller servicer, and we work direct with Fannie Mae and Freddie Mac and Ginnie Mae. Then we have broker channels as well. And those broker channels can offer all kinds of different product from an investment standpoint. From a general sense, the conventional programs, those we have your primary residence, certainly your second home, and your investment platform there. The investment related product that's tied to conventional. Conventional is such a good option for, phasing into property, initially speaking, where we have a lot of folks that, they're buying for the first time, or they buy with the notion that they're going to be in a property for a year or 2 years, and then they're moving out of it into a new property, because they're going to rent out the one that they just acquired.
Right. Absolutely. That's a popular strategy with investors.
Yeah. So do you want me to elaborate a little bit on that, or?
Yeah, let's talk conventional first. So maybe let's start. What does the application and approval process look like?
Yeah. So, in today's environment, it's really streamlined, which is really great. The biggest thing to get the client going with is an application. Most folks do that out of the gate, where they'll send a link of some sort that's a secured link, gives folks the ability to be able to log in, typically from a smartphone or from a computer. And what lenders are looking for out of the gates, there's really two primary focuses that I have when working with a client out of the gate. And that is, what is the maximum monthly payment that they're trying to stick within once the mortgage process is done. And then the second thing would be is how much cash or how much money do they have to work with in order to make the deal work. Now, the reason that those, questions are so valuable is because, there's so much going on within the real estate space where, there may be different product outlet that we can find somebody based on the amount of money that they have to be able to, then get them the loan that coincides with the payment that they're trying to stick within. So an example would be is I just had a client reaching out to us. They're looking at a second home investment property type usage where they're going to occupy the property for a period of time, vacational type purposes, but they want to be able to rent it. And so, the notion was, all right, we have X amount of dollars, we have 100,000 to work with, what's the strategy, based on where we can approve them for debt to income ratio, right? We got to keep it within a certain scope. Sure. And what we found was, they thought they were going to be shopping at a certain price point. And when really getting granular and identifying those two questions, where they want payment and how much they have to work with, we had to scale back because the lending has changed behind the scenes with everything that's going on with inflation. The government's really trying to temper, lending, and they're trying to make it harder to borrow money. So it slows things so inflation can catch up and get in check. So those really, really critical, getting the application out of the gates and identifying those two questions, because we're checking 4 primary boxes on an application. We have to look at credit.
Okay.
We have to look at income.
Okay.
We have to look at assets.
Right.
And then we're looking at the collateral itself, which is like the property and how does it coincide with the guidelines. Oftentimes the collateral box gets checked once the deal is in process, through an appraisal, something like that. But as an investor, where the type of property can matter depending on how much you can borrow on a specific type of loan. So a 1 to 4 unit property or a 1 to 2 unit property carries different loan qualifications potentially than a 3 to 4 unit property. And then if you get into conventional versus FHA versus VA, right, all plays into, the level of risk and what the options are.
Okay, so let's hit a few specifics on conventional. Conventional, somebody can use as a loan to purchase their primary residence. They could use it to purchase a second home, and they could use it to purchase a strictly investment property, right?
Correct.
All 3 of those fall under conventional.
Yeah.
What down payment, just as a general guideline, what are kind of the minimum down payment requirements for each usage?
Sure. So, and it's funny about this question because a lot of folks think that you still need 20% down to buy a house. I mean,
sure.
Again, you don't know what you don't know, but we do a lot of loans at 5% down. They will go really as low as 3%, but you have to fall within quite a few more parameters in order to get there. But really, it could be as low as 3%, but the general market is 5%. We do a ton of loans at 5%, a ton of loans at 10% down. And that's for standard primary residence purchase on conventional loan limits. And conventional loan limits, in my mind right now, is an interesting topic. Conventional loan limits on Fannie Mae and Freddie Mac, that's $726,200. And for years, and why that's interesting for me, if I can talk about that for a quick second, is for years that loan limit was at like 417,000 range. I think 417 or 420, something like that. Right. And since COVID and since, the last couple of years being a little bit, chaotic, we've seen this significant climb from, 420-ish to 484, then into the 5s and then 6. And now it's like, again, 726. So you've seen this massive jump, with consumers. So now you're starting to see a lot of first time home buyers buying in the neighborhood of, $400,000 or $500,000, which is, it's interesting. So,
yeah, it's up significantly from where a lot of first time home buyers were a few years ago. That conventional loan limit, does that vary by area? So is that the same in San Diego as it is in Pensacola?
The one thing to look out for there is something called high cost areas. And if it's a high cost area, somewhere like San Diego would probably be the case, somewhere like South Florida. And those high cost areas are probably going to be like, it probably won't be 726. It'll probably be like $1 million. So they kind of curtail that individualized area or geographic area and make that adjustment. So.
Gotcha. Okay. Awesome. Thank you. So, as low as 3%, but commonly 5 and 10 for conventional primary residence. What about second home down payment? General
Yeah.
requirements.
Yeah. So second home down payment's interesting. So because back in, really, I guess it was towards the latter part of 2021, Fannie and Freddie started saying, hey, we're coming out with these price adjusters that are going to impact second homes, whereby they're going to align them more with what investment property interest rates were. Now, so to answer your question, then I'll unpack it a little bit.
Okay.
So technically, second homes, single family residence type property, not condos, but single family residence, more of like fit inside the box, 10% down was common, I should say.
Okay.
You can get PMI on it. Great product, great option. 10% down was kind of like bare bones minimum. Now, because of the state of the economy, inflation doing what it's doing, and again, I'll call them the government or the powers that be, whoever's tempering the market to try to slow some things so that supply can catch up and so inflation can settle. You're seeing it where some lending institutions, it's with these price adjusters that have impacted rates, it's requiring the customers to have to put more money down. So whereas the guideline may say 10% down is available, we're having a hard time pricing out some of these loans sometimes because of the volatility that's going on in the secondary market, which is more of a detailed conversation for a later date. Sure. But so I know it's a long-winded answer to your question, but it's not a black and white answer like it once was.
Used to, we just kind of figured 10% on second homes, but that's gotten a little bit more complicated.
It has. So, you may be seeing 10% go to 15 or 20% and not be uncommon because, again, it's not that you can't do it at 10. You can, but you got to be able to lenders have to fall in compliance from a lending standpoint. And it's like we can't charge excessive fees in order to be able to get them that, if that makes sense. So it requires, in some instances, additional funds to be put into the transaction. So making it like a 20% down type deal.
Gotcha. Okay. Yeah. So, and I'll point something out because you've kind of mentioned it in a roundabout way, but part of your role in a good mortgage loan officer's job, they are going to take a look at the purchaser's overall financial situation and fit the right products to them, right? And then explain the benefits and why you would go one way and why you would do this or wouldn't do this. So part of your job is to understand the big picture and then put the people in the right product, right?
100%. I mean,
so people don't have to know all this. They can call somebody like you and say, here's my goal here. I want to buy something like this and here's my financial situation. And you're going to work with them to find the best product.
That's right. That's right. I mean, listen, man, like you're saying something that hits home to me because of how important somebody is, like a mortgage lender, or how important somebody, that's a real estate agent like yourself or investor, where we value relationships. And what's so critical about that is that, there's a big picture that goes into someone's landscape. Like there's so many times I'll get a call or a text or something that says, okay, what are your rates? I'm like, man, okay, that's so far down the line because there's so much to unpack in your situation. Like what's happening like in your life, what's going on with your goals, how are you trying to structure your real estate? I mean, it kind of goes back to where we started, right? Like, is this going to be a home you're going to be in for a year or 2 years? Or, are you phasing out? Are you then going to sell it? You're going to flip it? I mean, so a lot of things play into that, but back to your statement. Yes. I mean, a mortgage, originator should be really trying to dive deep, on the two primary questions, like I mentioned to you out of the gates. Where are you trying to keep your monthly payment? Where's your cash thing? But I can't tell you how many times I've talked to folks where they, their goal was, oh, hey, I just sold this property. I want to put all this money down on this new deal, and then I'm like, well, what's your plan next though after that?
Mm-hmm.
And then when you unpack that a little bit, they've got real estate goals that they're trying to meet, and
Right.
they don't want to buy just that property. They want to buy more. So I'm like, well, just so you know, you can get into this property with X amount. You can still have X amount of cash left over potentially for your next property. Because
Right.
once it's in the property, once all your equity is in the property or your down payments in the property, it's locked up. So then how are
Sure.
you going to get it?
Right.
So you want to look for a relationship. You want to look for expertise, to be able to guide those kinds of scenarios. So.
And to what you just said, for aspiring investors that want, or experienced investors, but people that want to grow a little bit faster by getting the most leverage out of their cash, usually their loan to value ratio on a purchase is lower than it is on a refinance, right? You might be able to get them in that property for 10 or 20% down, but the refi, they may not be able to pull that much back out, especially if it's strictly an investment property when they refi and it was an owner occupant loan initially.
That's a great point, and that's what I mean by the funds being tied up in the property.
Yep.
It's not as easy. If you're talking, I mean, I'll hit this head on, and I don't care who's listening to it. It's like if you go to somebody and they're just like, oh yeah, you get in the property and we'll refi you later. Like,
Mm-hmm.
watch out for that, because there's way more to that. It's like, okay, well,
Absolutely.
what's the market doing? Is it trending down? Is it tight? Like, are you going to be doing any renovations to the property?
Right.
How are you going to pay on your mortgage? Are you going to pay it down? Are you going to try to accelerate payments? Like, it isn't just like a guaranteed thing. All right, you're in, and rates drop in 6 months and we're going to refi you. It doesn't work like that.
Well, to your point, a real recent example, if somebody bought a property in late 2021 planning to renovate it and refinance and pull their money back out, how different was the rate environment in October 2021 versus June 2022?
Yeah.
If they didn't have some margin for error and they were relying solely on that refi, they probably got hammered.
Yeah. Yeah.
I mean, okay.
Put it to you another way, in layman's terms, for some of these people to pick up, some of the audience to pick up. We just saw a price drop of like 90 grand on a property, like on a, you know what I mean? And like, again, I'm not saying that that's like doom and gloom. It's not. Like, does the market need some correction? For sure. You're not pricing at premium prices right now. It's got to be realistic, but that's an eye opener at the same time too, to be like, you got to look out for the, oh yeah, just get in and then we'll do this later kind of thing. You should be asking questions. It should be a lot more detail to that. And like you were saying before, they don't need to know everything. They just got to have trusted resources where, like, you and I can help connect dots. I say that all the time. Like, I'm in the space where hey, I might not have, the right commercial program for you or a commercial program for you, but I can connect you to people that have been in the business, and that saves them time and helps them continue to run the path they're trying to run and achieve their goals.
Okay. Very cool. Last one I want to ask is the, typical down payment percent, or, kind of lowest required down payment percentage for a property being purchased exclusively as an investment, not a second home. They're never going to live there. They're buying, a duplex or a quadplex or a single family, and they're only going to rent it out. Sure.
So when you're looking from a conventional standpoint at those, you're looking at 20% down.
Okay.
However, what you will see from time to time is you'll see a decent improvement to rate if somebody can get to 25% down. Okay. And in some instances, even 30% down. So if the cash is there to be able to use to get into the property, just keep that into consideration. So can you get in at 20? Yeah. However, something else to take note of that's different in the investment space has to do with seller concessions. So right now we're seeing whereby normal allotted seller concessions, you can get up to like 6% when you're doing a primary residence and a second home. When you get into the conventional space, you're talking about like a lot lower cap. It caps out like 2% or $2,000, depending on the loan size.
Yeah.
in purchase price. So you get
Okay.
some real limitations there. So when folks are looking at getting into a property, you're definitely going to need a little bit more skin in the game. Now,
Okay.
you asked about single unit or duplex type thing. So that's, you're looking at 20%, minimum. When you get into the 3 to 4 unit, it's gonna stair step up for more of a down payment. You're looking at minimum 25% down, potentially 30. And I know we didn't get into FHA and VA, but the same kind of thing there. Like there's been some additional restrictions there, like at FHA, where the property has to be receiving a certain amount of rents based on the rent table that an appraiser is going to do on a property. And that was a recent change earlier in the year this year. So, but good news, you can use income when you're buying an investment property. You can use projected rental income that's coming in from the property that an appraiser would be able to determine.
You can, when you say you can use it, they can use it to help qualify them for the loan.
That's correct. You can use it for income.
Into conventional. That was great. Just one more thing on that. When we say conventional financing, that is typically going to go up to 4 units, correct?
Yeah.
Okay.
Yep.
1 to 4 units. Let's do a touch on FHA next. What can you tell us about FHA and the way that that it's different from conventional, and why somebody might use it instead of a conventional loan?
Sure. It allows for a little bit more credit issues. Let's say folks that may use an FHA loan may have a little bit more credit challenges. You may see some lower credit scores, that kind of thing. The down payment is also an opportunity through FHA. So FHA allows for as low as 3.5% down payment. Okay. The FHA loan is for a primary residence. Now, it's a primary residence loan where you're going to be occupying. Okay. Now, can you buy like multi-unit in FHA? Yes, you can. But there again, if you're buying it as a vehicle where you're looking for a low down payment, FHA, primary residence, single family home, you're looking at 3.5% down. What's also great about it is it allows for sellers to pay up to 6% of the buyer's closing costs and or prepaids. So it's helpful to be able to get the buyer into the transaction with just the 3.5% down. Okay.
All right. Then are the down payment requirements, do they differ by property type? So is it duplex, triplex, quadplex? Is that still all 3.5%, or does it start to go up?
So you're going to see an increase in so from a 1 to 2 unit, you're going to be at 3.5%. When you get over that, when you get to 3 to 4, you're going to see an increased down payment. Like, and I want to say it's 25% on that. You see a pretty substantial jump. And like I mentioned earlier briefly, that when you get into the 3 to 4 unit, you then have a formula that has to be met for rent purposes, and the property has to be able to carry itself. If you're using rental figures where you need the rental income to qualify on the subject property, the property will have to pass what's called it has to sustain itself. So the rents that are being received have to be able to cover the principal, interest, taxes, and insurance on the property. Okay. So if it's a 4-unit property and you're going to occupy one of the units, you have 3 units that are left. Those units have to cover the note on the property and the principal, interest, taxes, and insurance. So it's interesting right now, again, because of what you're seeing in the market, where this product's not used a lot, and not a lot of people may know about that sustainability test, but it those 3 units would have to carry the whole note on property.
And is that true on a 2 unit as well? So if somebody bought a duplex, does the rent on the other unit? No, only once you get to 3 and 4.
That's right. Yep.
Okay, good. It would be harder to meet that as with just a duplex because you only have 1 unit to pay that note. Right. So wanted to make sure we clarified that. And so it's owner occupant loans only. Obviously, if they've got a multi-unit, they don't have to occupy the whole space. They can rent out the other units. Are there any provisions that would keep them from renting out bedrooms inside their unit or anything like that, or they just have to occupy some part of that building?
Yeah, I mean, there again, if it's a duplex, you're going to be occupying the one side as a primary. I mean, can you, once you close on it, can you sublease it kind of thing and do something like that? I mean, I may get in trouble to say yes to do
No,
that.
I'm not saying move out. I'm saying,
Yeah.
can they live in their bedroom, and if they buy a two bedroom duplex, could they live in one bedroom, rent one bedroom, and then rent the other side?
Yeah, I mean,
Okay.
I don't know. If
There's
somebody wanted to, I gather that they could.
Yeah.
Because you theoretically would still be the primary, they would still be your primary residence. The thing is on a lot of those notes and mortgages that you sign, I believe it's in the note that's signed where you are stating that you're going to be occupying the property for at least the next year as the intended purchase. So if you're buying as a primary residence, the intent is that you're occupying the property for the next year before something, for you.
Right. Okay. Thank you for bringing that up. So the term that they're expected to live there is 1 year. And I think, probably an important word is in there is intended, that you intended to live there for a year. So if you buy the property and you never lived there, you never intend to live there, we would call that mortgage fraud. That is very bad. But if you bought the property and then you took a job you live in Pensacola, you bought the property here, and you take a job in Arizona in 6 months, they're not likely going to hunt you down for not living there the full year, right? Because you had a true intention.
Right. I mean, like, life happens, you know what I mean? And circumstances change and situations do. I think what I would probably understand that to be is, and again, I'm not an attorney, so don't, you seek your legal counsel, but, I think the intent is there is, intentional mortgage fraud. Like you said, are you intentionally doing it, under the scope that you were never intending to occupy it? And there again, what it does is it gives the lender or financial institution the legal right and ability to initiate the due on sale clause.
Right.
So it's basically you lie, or you're not making payments, then that's not what it's intended for, right? I mean, it's intended to keep, you as the buyer safe, and the mortgage company, the one that's lending the hundreds of thousands of dollars out, that everybody's doing what they say they're going to be doing. So,
okay, good. I get questions about that, and people that maybe don't intend to use it and as their primary residence want to know if they can use a conventional loan. And I'm always like, no, you just can't. It's not worth it for somebody who honestly uses it and intends to use it. If you move out a day early or you get transferred to Phoenix or something, it's not something where they're going to come throw you in jail, but there's a little bit of nuance there.
So, I mean, listen, man, we just had a circumstance or situation recently where, somebody acquired a property, was, mid-June of last year, and, job circumstances changed, familial situation changed, as far as getting married, and so his job took him out of town, and he was getting married, and, so he had this, it's like, what are you doing? I mean, so, you know what I mean? Like, you didn't need the circumstances of that change. It's like, I mean, what can you do? But the other thing is, so what's the biggest takeaway there is the mortgage payments being made, right? Like, that's the name of the game. So,
you stop making math, you get a lot more questions.
That's correct. But it did impact his scenario, because we're looking at something different for him now, because it's within that year's time frame, so, and I won't dwell on that, but that's something we're navigating, and it appears to be that we're going to be in an okay situation to be able to still execute another loan for him.
Yep.
Even though it's within that year's time frame. Why? Because life happened. And
can we take just a second and explain conventional mortgage would have PMI. You mentioned that earlier. We take a second and explain what that is, and then quickly the difference in PMI on a conventional and how that works with an FHA loan, since you're also using a lower down payment most time on FHA.
Sure. So PMI, it stands for private mortgage insurance. And what it essentially is it's a risk factor that's tied to a deal. So I opened up earlier saying, a lot of folks think you have to put 20% down on a deal. You can. A lot of folks do. And that's the baseline cutoff when it comes to PMI. So anytime you put less than 20% down, I shouldn't say anytime, but there are times when you put less than 20% down on a transaction that you have to pay private mortgage insurance. And what it is there are companies out there that are private mortgage insurance companies that they secure the risk tied to that given loan. So for example, like if somebody puts 15% down versus 10% versus 5%, every incremental adjustment on there where the lesser amount of money is put down, the higher the risk it is for a mortgage company, because a customer theoretically has less skin in the game, right? Is kind of the notion there, and has less loan to value in the game or in the deal. And should a mortgage payment not be made, the closer they are to 100% of the loan to value, the harder it makes for the bank to then be able to, recapture the product, turn around and sell. I mean, banks aren't in the business, or mortgage companies aren't in the business to own property. They're in the business to lend money, right? So they don't necessarily want the asset, which is the property. So the PMI company comes in and they insure that risk based on those levels of down payment that I just kind of mentioned to you, the 5, 10 to 15%. So the least amount of money that you put down, the more expensive the private mortgage insurance is going to be. But what's interesting about it, though, is, when I have folks that come to me, I have folks that are well-to-do that have the funds and resources to put 20% down, for example, but they've opted to put 5 or 10% down on a transaction. And it's funny because when you unpack that and you look at the cost of the PMI on the deal versus how much money the additional 10% would be to put into the transaction, they've made educated decisions and they've put 10% down so they could keep their cash. Why?
Right.
Because again, that big picture, like we were talking about, what's playing into it and how are they navigating, their lifestyle, their future real estate goals, their investment. So I've had some folks that have just opted to keep the cash because the PMI, meets the need. Now, if you flip that to from conventional to FHA, FHA carries an upfront cost to the private mortgage insurance. It's actually called MIP, mortgage insurance premium. That's a initial upfront cost that's added to the back of the loan. So the customer doesn't have to pay it out of pocket. They finance it into the loan. Again, this is a government-backed product that, the risk is taken and allotted for these terms on the loan because of how they're structured. So the MIP is added to the back of the loan. So
if they borrowed $200,000, they don't have to pay an MIP is $1,000. They don't have to pay the $1,000 up front. They simply get a mortgage for $201 instead of for $200.
That's correct.
Yeah.
Now it has to it the MIP, the mortgage insurance premium that's on the front end that is added to the loan, like we're talking about. And then it also carries a monthly PMI that's tied to it, that private mortgage insurance that goes kind of hand in hand with what I was telling you before, except for it's a little bit more costly because you're dealing with, because of FHA, the product as a whole and the risk that's tied to it. So so the cost is a little bit more. So a great question though, or a scenario would be this though, is if I'm working with a client and they can put 5% down and we can go conventional, most of the time rates are comparable. but the PMI might be cheaper on the conventional loan, we'll try to go conventional versus even if versus the lesser amount of money down at 3.5% on an FHA loan.
Mm-hmm.
But because the PMI is higher and the PMI sticks around it stays tied to the FHA loan. Whereas conventional, the PMI can go away.
Right.
As long as, value goes up and the mortgage is also paid down. Once that threshold is met at 78 to 80%, that PMI just falls off. So it's not an expense that you have to continue to incur on a conventional loan versus FHA you do.
Okay, very good. I think that's a really good point for people to remember. With conventional, you get a certain percent of equity, the PMI falls off. We just had that happen. My wife asked me why the payment on a rental property was like almost $200 less all of a sudden. I said, well, the PMI fell off. But with FHA, your PMI never falls off. You could have 99% equity and you're still paying PMI, right?
Right.
Yeah. So
now I think you can put like you can do a 15-year term or put a certain amount of money down and it can fall off after, I don't know, like 8 to 10 or 15 years or some sort of thing. So I won't say never, but that used to be the case where it would fall off. And in most instances now it won't fall off. So it's a good rule of thumb to go by. Yeah.
Good. Very good to know. Well, let's hit VA.
Yeah. I was going to say, dude, on VA though, huge. Like I love VA. Like VA has an upfront, what they call a
funding fee, right?
Yeah, the funding fee. Thanks. I'm like drawing a blank. Thanks for telling me. But the funding fee, what I love about VA is, so VA charges the funding fee similar to FHA because of the risk associated with the loans being 100% financing. So you buy a home for $300,000, the loans for $300,000, but it has the funding fee on there. There's no built-in equity yet. So there's still there's risk from the sense, if a consumer's looking at this and listening to this, it would be, what's the risk? Like you got to have skin in the game, and that's kind of how the lender's looking at it. So because of that, the funding fees added to the back of the loan as well. So like we were talking about earlier. Now those funding fees, they can scale a little bit, or they can adjust depending on if you put 5% into the deal or if you put 10% into the deal. That funding fee reduces, which is great. But that's added to the deal. The other great thing, though, is there's no PMI tied to these deals, which is fantastic. So from an affordability standpoint, as we were talking about earlier, oftentimes you're getting a lower rate with no PMI, and does it make sense to do? The only time I really get a question, when they're like, hey, should I go VA or should I go conventional because conventional doesn't have the funding fee? I'm like, it's like 9.9 out of 10 times. It's like, you go VA, right? If you have a chance to. Now, again, not in all circumstances. I shouldn't say that because VA is only for primary residence purchase, same kind of thing we were talking about earlier. So there's a little bit to unpack there depending on the customer needs.
But again, you're there to kind of help them see the whole picture.
Totally. Yeah.
Okay. Who can get a VA loan?
So veterans are, active duty or retired, or disabled. Once you got to pull the certificate of eligibility, and as long as they have eligibility, then they can get the loan. Okay.
And VA, you can go 0% down payment, correct?
Yep.
And the seller can pay part or all of your closing cost?
Yep. So the seller can pay, the technicality is the seller can pay up to 4% of the sales price towards the borrower's closing costs and prepaids. And I guess in some instances now, we've got interest rate buy downs. That's a hot topic that people need to know about. But so that 4% typically covers all the costs, and a lot of lenders I don't know about a lot, but as a lender, we don't charge any lender fees on our VA loans. So, love our veterans, they protect and serve and keep us safe. And, so we give back, from that sense. So we don't charge any lender fees. So every fee that's tied to the deal that you're paying is a third party, related fee. Like you got to have insurance. You have to have,
survey,
property taxes, survey. You're going to pay title fees, things like that. But we waive the lender fees on that. So the seller contributions cover those.
Very cool.
But
So I think
now I mention one more thing on that. So because I get this from time to time that I do have folks come to us that are using VA and they're like, oh, well, we can roll the cost into the deal, or like, yeah, we're just going to have, we're going to add the cost to the back. And it's like, well, we can, as long as the seller agrees to it in the contract. Right.
Right.
So sometimes again, but that's sometimes a misconception that people think like, yes, the seller can cover the cost, but again, it has to be agreed to. It's not just an automatic, like, we're buying a $300,000 house, closing costs, $6,000, whatever the number is. It's not like you can just say, now the loan's 306, because your closing costs rolled, and the seller has to agree to it up front in the contract, which is something that you would do.
Yeah. So that's part of their negotiation process with their agent, but they really need to talk to you, and understand up front what their expenses are going to be. And if they need that, in that case, it's really simple. You buy the house for 306 and the seller pays for $6,000 in closing. So it's still like 300 to the seller. It's just that you were able to finance your closing costs through the higher price.
Totally.
So we've covered the loan types pretty in depth. So just real quick, VA is owner occupant. You've got to be a veteran or active duty, but you have to have, military eligibility to get one. Like the other loans, you can do fixed long terms like 10, 15, 30 years. So two things I want to make sure we touch on, and that's with FHA and VA loans, you have a few more property requirements and your appraisal is a tad different. So if you can hit that, and then I would love for you to explain the VA entitlement, because so many people don't understand that and they don't know that they can use their VA loan more than once in certain circumstances.
Sure. So, the other thing, Matt, that I would unpack on the VA is, that you hadn't asked it yet, but I want to make sure to hit it is, same kind of thing from a property type. Like it doesn't need to be just a single family. It can be duplexes. It can be, quadplex kind of thing. I mean, we have several folks. I mean, we have a concentrated group of veterans that understand the wealth component that's tied to using the certificate of eligibility / the VA loan, right? I mean, they get stationed somewhere for a couple of years. They come in, they buy right. They may buy a duplex, find a great agent like yourself, find them a duplex. They live in one side, then they're out, and then boom, they got 2-unit property that's more than covering itself. They're making money off of it. So it's huge. I mean, you got it using that as a vehicle. So there's that. You asked property restrictions.
And I'm going to say thank you for bringing that up. And can I point out, they can do on a triplex or a fourplex, they could still do 0% down, right? With VA specifically.
I think you can.
Okay. I know I've done it on 3 units. I can't remember on 4 for people, but I had a, young military guy that bought a triplex in downtown Pensacola when he was stationed at NAS Pensacola, 0% down, seller paid the closing cost. 9 months later, he gets transferred up to Whiting Field in Milton, which is 40 minutes away. And because his station changed, he was able to use the rest of his entitlement and buy a duplex in Milton. So exactly what you're talking about.
Yeah. There may be something on VA pertaining to three unit, like 1 to 3, and then something with 4 units though. So
okay,
I'm not going to speak to it because I don't know. I'm drawing a blank on it right now that I'd have to clarify that for you.
Okay, but that's fine. We can look it up and I can put it in the show notes.
Point being, thanks for that. But point being the same is like such a major advantage, especially to get in at 100% financing. No money down. I'm working with a couple of folks right now that are looking to do the same thing. Awesome. But we're looking at duplexes, right? Okay, so cool. Anyhow, then what was the next thing in order to talk about?
So the property condition requirements. What kind of condition does the property need to be in, just generally, to be able to qualify for an FHA or VA loan?
So it's got to be habitable, and the big thing there is wood rot. That you've got to get on VA. You have to get a termite report. Often you'll hear the acronym WDO, stands for wood destroying organisms, right? Like it needs to be able to make sure that there's no wood rot. We don't want termite damage down here. So all that's got to check out for sure. So those would be initial, initial property characteristics that you would focus on for sure when you're looking at a property. If the borrower is going to be VA, for example, I'd be looking at that as you're perusing the property, because line
Sure.
items on the contract, pertaining to repairs and whatnot. Like it's coming, so you might as well have it prepared. You might as well have a handyman or somebody ready to go on that kind of thing.
Right.
So.
Okay, good. And then, like I said, I think a lot of people don't fully understand the VA entitlement. So can you take a minute to explain that?
Sure. So VA entitlement is, you're basically there's no loan limits also on VA with an asterisk. So there's no loan limits. You can buy $1 million property as long as your entitlement is fully, as long as there's no usage of your entitlement. Mm-hmm. And obviously you have to qualify, right? Income wise, asset wise, sure. Whatever. But so from a loan standpoint, there's no loan limits when that's the case. Now, you have a certain amount of entitlement that you can use, that if you were to use your VA loan twice, there has to be enough entitlement left over. So although if it's single usage, there's no loan limit, when you're using it twice, loan limit does kick in. And when the loan limit kicks in, you're going to be based oftentimes on the loan limit that's tied to the specific county. So like you said, in most instances, that loan limit follows conventional guidelines. So you're looking at like $726,200. So to keep it in kind of layman's terms for example purposes, you almost like if you were to look at $726,000 as the total amount that you could use, right? And then you split the number in half. It's almost as if you wanted to get 2 VA loans at 100% financing, it has to kind of total the $726,200. It's kind of an easy way to look at it. Now, because there's a formula, because it's tied to analytics, we would put in the formula and say, okay, the borrower's used X amount of dollars of entitlement. This is the loan balance on their existing property. Right. And then how much are they trying to purchase on the next one? And then that formula that we run ends up telling us, okay, you're within the parameters of qualifying for that at 100% financing, or in some instances, you're not. And when you're not, what it tells us is what is the down payment structure that's tied to the deal. So although, like, let's say you may not qualify at 100% financing, you may qualify at 98% or 97%. It's that kind of thing. So loan amount on existing home has impact, and then has impact to, what the purchase price is on the new one that you're looking at. So still a great opportunity. That's what we see a lot of times. Because again, I can't tell you how many times, Matt, I see it where people, they're in their existing home and they've got all their equity tied up in their existing property. And I hear this a lot on conventional deals. Well, I don't want to have to sell to get my equity out, but I want to buy something new and I want to put the equity into the transaction. Kind of same thing here. Like you may have entitlement that you can use on your next property too. It's really nice to know that. We see some folks sometimes that restructure their debt. So let's say, which to me, this is huge. If I was VA, I would be doing stuff like this. Like if I got into a property, I was there for a couple of years, I would be looking at, do I have the ability to restructure the debt and potentially
to refinance,
refinance out of the VA loan, maybe into a conventional loan, free up my VA again, and utilize it going into the next property. Listen, so many people that talk about rates, it's important. Don't get me wrong, but come on, like 15 years ago, 20 years ago, people made millions and billions of dollars when rates were 15% and 20%. So, I know it's different in perspective matters, but my point is when you restructure the debt, you can restructure the debt, and as long as the rental, is paying for it, but it's freeing up for the long term, right? So it goes back to similarly to what we've been talking about. What's the big picture we're looking at, and how are you navigating to meet your goals for long term? So
awesome. And so the big thing I want people to take away there is just that there are multiple ways that you can use your VA loan multiple times, either by refinancing or having leftover entitlement. And if you have a good, knowledgeable mortgage loan originator like Nick, then you talk about that up front. You can plan your first purchase to have entitlement left. You can talk about refinances, but having a really good professional on your side lets you reuse the VA loan, which is just a huge asset for anybody that qualifies. Nick, you've been super generous with your time. I know we went a lot longer than we planned, but thank you so much. Is there anything that you want to leave the audience with before we sign off?
Just a couple quick things. Really, that I do think it's relative to share. Appraisals, we're at a time where values are kind of, doing one thing and settling a little bit. Just kind of keep an eye on especially for VA appraisals. There's some contingencies in there where notice of values may come up, where if an appraisal doesn't meet. I mean, I think appraisals could be getting a little tighter these days, but VA is pretty cool that VA still may support the transaction. So just kind of know that. I won't even dive deep into that, but just know that there's some leniency there when working with VA. I will say buy downs right now is something that's important for folks to be able to understand and know. There's a lot of volatility in interest rates behind the scenes, and where super helpful to know, like traditionally speaking, a lot of folks don't pay like a discount fee or an origination fee to buy down. Like a lot of lenders, it's not normal that they would normally charge that. And because there wasn't a large spread in the rates, and now we're seeing a larger spread in the rates. So it's good to take into consideration, because that money could be well spent. Where if today's rate was 6% and you paid a 1% buy down fee, to keep it simple, historically that might only get you an eighth or 1/4% improvement in rate. And now, for whatever reason, we're seeing like 0.5% to a whole percent improvement in rate.
Huge.
So again, like you got to know the full picture and how much people are working with, but it's just good intel to know, because there again, if they can come up with the cash and it's available, we're at a time where, who knows how high rates really have to go for, the financial equation to kind of start over or stop, or this inflationary thing to get in check. So it's important to know, from an affordability standpoint. And then temporary buy downs is a big thing right now too. The last 15 years, we haven't needed them. Everything's great when it's great until it's not. And so, you're trending. The last 15 years, there's been this constant trend, slow downward with rates, right? So it hasn't been a thing. We haven't really needed them. And now we need them. And so the cost for them, in order for consumers to use them, the cost is paid for by the sellers, but it's really a great vehicle for buyers, because I'm talking some significant improvement to the numbers. Like we were run numbers that on a $400,000 deal, if somebody took advantage of a 2-1 buy down, I want to say not only did it buy the rate down 2 points, but more importantly, like the payment for the first year was like $450 a month cheaper. And so, the cost on it being like 10 grand, a lot of folks don't understand. They don't know this. So like rather than a seller just dropping their price 10 grand, in that instance, it only saves the borrower like $60 a month. Keep the price where they're at. Sellers pay the buy down expense, maybe 10 grand that you were already going to drop the price on, right? It keeps the values at a steady level. So now we don't run into appraisal issues as well. But that same 10 grand, giving the borrower the benefit of $450 monthly savings, which helps us get a little bit further through this inflationary stance, that the economy's in right now. So, Um, so that I'd leave it at that. And I'd also leave it with the fact that we've partnered with a guy by the name of Barry Habib, who runs MVS Highway. Barry's a financial mortgage economic like guru, and really has a good handle on the market and following interest rates and stuff like that. So Barry, we partnered with him. Barry's coming out with another presentation. I think it's on maybe around the 20th. I can get you that information. Any folks that are interested in it that want to chime in, it's going to be an hour presentation where he'll get online and he'll do his thing. So it's not like, you gotta see that, you gotta be there, or you can do it at lunch and listen to it. But he's going to unpack where we are currently in the economy. He's going to talk about how we're short on housing right now. He's going to talk about the statistical data that is going to deliver the focus of why housing is so important and the trajectory of where it's going, that now is still a great time to buy, kind of thing. So knowing the vehicles of the buy downs, hearing this should give everybody the comfort that they need, to know that, again, still now is a great time to buy. So I'll leave you with that. I'll get you that information, and so thankful to spend the time with you and really appreciate.
Thank you so much for coming on. It was really great info. Nick, if people want to connect with you to learn more, to get a loan, or, I know GRA is a very large company. So if they just need to get connected with a loan originator where they are, how can they contact you? How can they get in touch?
Yeah, so for sure, I mean, reach out to me via cell phone. That's great. My telephone number is 850-529-0282. My email is nick.redhead@grarate.com. So nick.redhead. Yes, I know I don't have red hair, but nick.redhead, REDHEAD @grarate.com. We'd be glad to help and direct traffic. I mean, if we can help, we'd love to. And if it's something that's not in our wheelhouse, we'll be happy to direct traffic and help them connect the dots. So
awesome. Well, thank you again so much for coming on.
Yeah, enjoyed it. Thanks so much.